Hey, what's up, all my future CPAs in the Philippines? I know you're deep in your LPI review, and let's be real, capital structure can feel like a total beast. But hey, don't sweat it. We're going to break it all down, give you the hacks you need, and make sure you absolutely ace this section on the exam. So, you ready? Let's dive in. Okay, so everything, and I mean everything, we're talking about today really comes down to this one big question. How should a company pay its bills? Do they take on debt or do they use equity? Now, your textbook probably gives you a nice, clean answer, right? Well, let me tell you, the real world, it's a whole lot messier, and that's what we're here to unpack. All right, section 1, the perfect world myth. We're going to start where every single textbook starts, in this kind of perfect imaginary world. This is where you first run into the famous Modigliani-Miller theory, or as we all call it, the theory. So Modigliani and Miller said that in these perfect markets, how you fund your company, your capital structure, has zero effect on its value. But here's the catch, and it is a huge catch. This only works in a world with, get this, no taxes, no bankruptcy costs, and where everyone knows everything. I mean, does that sound like reality to you? Yeah, me neither. It's totally unrealistic. The real world is messy, right? We've got taxes, we've got risks, and we definitely don't all have the same information. So you know what? It's time to bust this myth. Let's leave that perfect little theory in the textbook and jump into how things actually work. Because out here, capital structure is a really, really big deal. Okay, section 2, the great trade-off. This is our first and honestly most important dose of reality. If you're going to remember one thing for your exam, it's this, the trade-off theory. The best way to think about it? It's all about balancing the good and the bad of taking on debt. So the whole idea is actually pretty simple. On one hand, debt is kind of good, right? The interest a company pays on its loans is tax deductible. We call that the tax shield. It literally shields your income from taxes. But, and this is a big but, if you take on way too much debt, you're dialing up the risk of getting into serious financial trouble, maybe even going bankrupt. It's the classic risk versus reward game. And this formula right here, it basically lays out the whole game plan. The value of a firm is its value without any debt, plus the value of that tax shield we just talked about, minus the potential cost if things go south. So, what's the mission? Find that perfect sweet spot where you get the most tax benefit without taking on too much risk. That sweet spot, that's your optimal capital structure. But what exactly are these financial distress costs? Well, you've got the direct costs, the obvious stuff like legal fees and all the administrative headaches if a company goes bankrupt. Those can be about 2 to 5% of the firm's value. But honestly, the indirect costs, they're usually way, way worse. We're talking about customers getting scared and leaving, suppliers demanding you pay them in cash up front. Your whole reputation can just get torched. And then there's this other thing called agency costs, which is a whole other level of problems. We'll get to that one, I promise. All right, section 3, the manager's pecking order. So what if choosing between debt and equity isn't about a perfect mathematical formula? What if it's more about, well, what managers are thinking, especially when they know more than you do? This brings us to a totally different way of looking at things, the pecking order theory. The big idea here is something called asymmetric information. Sounds complicated, but it's not. It just means that the managers, the insiders, know a lot more about how the company is really doing than we do, the outside investors. And because of that info gap, they have to be super careful about where they get their money, because every choice they make sends a signal to the market. So there's a specific hierarchy they follow, a pecking order. Step 1, always use your own money first. That's your retained earnings, the cash you already have on hand. It's the cheapest, and it doesn't send any weird signals. Step 2, if you run out of your own cash, then you go issue some debt. And step 3, the absolute last resort, that's when you issue new shares of stock. So why is issuing new equity the absolute last choice? It's all about something called financial signaling. Think about it. When a company takes on debt, it's like they're telling the market, hey, we are so confident we can pay this back with future profits. It's a sign of strength. But when they issue new stock, whoa, that can be a major red flag. Investors start wondering, why are they selling stock right now? Do the managers think it's overvalued and about to drop? See the difference? Okay, let's get into those hidden costs and conflicts, those agency costs of debt. Remember I said we'd come back to this sneaky one? Well, here we are. This is a super important piece of the puzzle. Basically, agency costs are all about the conflicts of interest that pop up between the shareholders, the owners, and the debt holders, the lenders. And these conflicts get really bad when a company is in financial trouble. Here's the bottom line. When a company is teetering on the edge of bankruptcy, what the owners want and what the lenders want can be completely different things. Their goals are just not aligned anymore. What's good for one side is suddenly really, really bad for the other. Let me walk you through a classic exam scenario called the asset substitution problem. Okay, picture this. A company is in deep, deep trouble. The shareholders might get together and say, you know what? Let's gamble the company's last bit of money on some super risky long-shot project. Now think about it. If by some miracle it succeeds, who gets all the profit? The shareholders. But what happens if it fails? Well, the company goes bankrupt, and it's the lenders who are left with nothing. It's a classic heads I win, tails you lose scenario from the shareholders' perspective. And then you've got the total flip side of that coin, the underinvestment problem. This happens when a company has so much debt that a perfectly good, safe, and profitable project comes along, and the owners just say, no thanks. Why on earth would they do that? Because they know that even if the project makes money, all of that cash would just go straight to paying back the lenders, and they wouldn't see a single cent of it. So they just don't bother. Okay, guys, this is it, the part you've been waiting for, your LECPA exam hacks. We're going to take everything we just talked about and boil it down into a super simple cheat sheet for these theories. So get your phones ready because you're definitely going to want to screenshot this stuff. Hack number 1. For the trade-off theory, the key word is balance. Just picture a scale. On one side, you've got the good stuff, that juicy tax shield from debt. On the other side, the bad stuff, the costs of financial distress. The entire goal is to find that perfect, optimal balance between the two. And hack number 2, for the pecking order theory, your magic word is preference. Think of it like a manager's preferred checklist for raising money. What do they prefer first? Their own internal cash. What's next? Debt. And what's their absolute last choice? Equity. It's a list of preferences, a hierarchy, a pecking order. Okay, now listen up because this slide is pure exam gold. This is the classic question they love to ask, comparing these two theories. So, first question. Is there a target debt ratio? Trade-off theory says, yes, absolutely. Firms are always trying to find that perfect, optimal mix. But pecking order theory, it says nope. The amount of debt a company has is just the result of its financing needs, not some target. And now for the big one, the one that trips everyone up, profitability. The two theories predict the complete opposite. Trade-off says, more profitable companies use more debt to shield those big profits from taxes. But pecking order says more profitable companies use less debt. Why? Well, because they have more of their own cash to use first. See? Total opposites. And here it is, the ultimate review table. Seriously, if you only screenshot one thing, make it this. Let's lock this into your brain right now. Trade-off theory, the core idea is balance. In the key prediction, a positive relationship. More profit equals more debt. Got it? Okay. Pecking order theory. The core idea is hierarchy. The key prediction, a negative relationship. More profit equals less debt. This right here will save you so many points on the exam. So that kind of leads us to the final big question, right? If every company is so different, can one single theory ever really explain everything? And the answer is probably not. The real world is just not that clean. Some companies lean more towards the trade-off theory, others act exactly like the pecking order theory predicts, and a lot of them, they're doing a mix of both. So the real key for you, not just for the LSCPA, but for your entire career, is to stop asking which theory is right and start asking which theory best explains what this company is doing right now. That's the kind of critical thinking that's going to make you a fantastic CPA. You've got this. Good luck with the review.